students, so I hope this video finds you well. So for this video we are going to look at the determinants of exchange rate, Australian exchange rate, or factors affecting exchange rate movement in Australian dollar. Okay, so there are six factors. In your manual you may have seen 5 and then 6, it is parked under a different section C, but it is continuous, it is all factors, so I just put it together. Okay, so for Australia, first factor affecting their exchange rate will be the commodity price. That's the main factor that causes exchange rate movement to change, besides speculation. Okay, we will cover that in a bit. So commodity price and terms of trade, these two I can put it together because commodity price affect terms of trade. Okay, commodity price rises, TOT movement becomes favorable. Commodity price fall, TOT movement becomes unfavorable. So it moves in the it is interlinked. Okay, so assuming commodity price rises, okay, now here we will see commodity price rise very soon, particularly iron ore, because even many countries in the world are facing COVID-19 issues, but China is getting out of it already. So many Chinese factory has started operating, and even started operating at at faster faster rate. Okay, so their production is even faster now. All right, so as commodity price rises, if it were to rise later, then export price index should increase. So if export price index increases, as I've mentioned, TOT movement would be favorable. So how would it then affect exchange rate? Very simple. Remember, favorable movement of terms of trade has got direct relationship with your export revenue or your BOGS later. Okay, since it has a direct relationship here, so favorable movement, export revenue would rise because our PED is less than 1. Okay, so if that's the case, we can see here our demand for AUD would rise because export is an inflow transaction. Since it is an inflow transactions, when revenue rises, it means inflow rises. Inflow result in rises in demand. Okay, this is very, very important. You have to write. When you say AUD appreciate or depreciate, you will have to tell the examiner, is it because demand changes or export changes? Because it has to be reflected in your graph. So you will have to tell the examiner which one changes. Okay, so demand for AUD rises, then AUD appreciate. Demand higher, price higher. Simple principle. Okay, so as commodity price rises, we also see export revenue rises. Just now, right, we have already mentioned here export revenue rises. I'm just putting it here. Okay, I don't want to repeat the whole thing, so I just put it here. So export revenue rises, most likely your CAD would improve because we are assuming ceteris paribus here. So most likely CAD would improve. So if that is the case, when CAD improve, you will attract foreign investors. Their confidence level will be higher because your deficit is smaller. You are externally more stable. So they will be more attracted to invest. So if that's the case, then demand for Australian dollar would rise and Australian dollar would appreciate. Foreign investment rises here. This is capital inflow. So capital inflow rises, more inflow, more demand. Okay, now also commodity price may attract speculators. Speculators are those people who speculates or forecast what is going to happen in the economy, and from there they just make their investment. Okay, so speculators may respond to the increase in the commodity price. They may assume that when commodity price rises, all these things will take place. Export revenue would rise, currency would appreciate. They would also expect that to happen. If they were to expect that to take place, then they will buy more AUD now, Australian dollar now, so that they can gain more when Australian dollar actually appreciate later. So they create more demand. And of course, when you create more demand, Australian dollar would appreciate. Okay. Second factor is the interest rate. So when we say here relative interest rate, this is relative interest rate we have covered before. We are looking, but our area that we looked at before this is only looking at Australian interest rate. So Australian interest rate low, no one wants to invest in Australia in terms of loan and all that. That one we have covered. So now we are bringing it to a little bit higher level, of which you can also apply in the previous chapter one, no problem. Okay, it just depends on your storyline. Okay, so here relative interest rate, what I have written here is I'm comparing interest rate of Australia with another country. So here I give you a fact already. Here I says in March 2020, which is just recently, US cash rate is 0.25%. Australia is 0.75%. Yes, 0.75% is very low, our cash rate, but US is even lower. Okay, it's 0.25. So if you want an American, wouldn't you want to invest in Australia instead of investing in US? If you want to invest in terms of depositing money into the bank or buying bonds or giving loan, wouldn't you want to do it with Australian instead? Because there's the difference here of 0.5%, you know. Yeah, so if you were to put money in US bank, your interest will be lower. If you were to give loan to an American, American giving loan to an American, interest very low. American putting money in American's bank, interest very low. So why not give loan to Australian? Put money in Australian bank, interest higher, you earn more. Of course, not much of difference lah, but that's the current scenario. So the difference, so this is what we call differential in interest rate. There's a differential of 0.5%. So if that's the case, yeah, you will attract more foreign investors to come into Australia by giving loan or depositing money. Then of course AUD demand will be higher, because if they want to invest in Australia, the currency has to be converted into Australian dollar at some point. So demand for Australian dollar would rise. Okay. Number 3, world economy growth rate. This one you are looking into your trading partners' economy growth. Okay. So for Australia's trading partner, we know that many of our trading partners are developing, they are emerging economies. Since they are emerging economies, so what happened is their demand for Australian product would increase, and particularly commodities. They are emerging, they need a lot of commodities. So demand for Australian export would rise. Then when they demand for Australian product, they have to pay. So export would rise. Export rises. Export is inflow of money, leading to demand for Australian dollar to rise. Okay, and we say more funds available. When their country is emerging, they got more money, so they can invest in Australia. Then if they were to invest, then definitely we are looking at the fact that demand for Australian dollar would rise and Australian dollar would appreciate. Next, speculation. Okay, now remember I said speculations, these are the people, speculators, they speculate or they forecast what is going to happen to a currency movement or a world economy movement and all that, and then they make investment from there and earn money lah out of it. Okay, so the fact is 80% of currency transactions in the world are not because of import and export, cargoes that go in and out. No, not because of you traveling or studying in overseas, not because of foreign investment in other form, but because of speculation activities. Okay, 80% of currency transactions. Okay, because they can buy now, appreciate, sell it. Depreciate, buy, appreciate, sell it. It's so simple for them to do it online. Okay, so if speculators, for example, they think that Australian dollar is going to appreciate, they will buy now and demand will increase and appreciate. So once appreciated, then they will sell it. So if they think the Australian dollar is going to depreciate, oh, they have a lot of Australian dollar in hand, quickly sell it off. Result in higher supply of Australian dollar and causes Australian dollar to depreciate. Okay. Point number 5. Relative inflation rate. This one is about Australian inflation rate. So if Australian inflation rate is relatively low, what will happen is price of Australian goods and services would increase at a slower rate. Okay, still increase. Don't say inflation rate is low so price will reduce. No, price would still increase but at a slower rate. Then of course your export will be relatively cheaper. If you are comparing to inflation rate in other country, your inflation rate is lower, then your price of your product would at some point be relatively cheaper. We are referring to non-commodity again. For commodity, it's based on world demand and supply. So our inflation rate doesn't really change commodity price much. Okay, so non-commodity price will be cheaper, international competitiveness level would increase, demand for export would rise, demand for AUD would rise, AUD would appreciate. Okay, now if Australian inflation rate is relatively low, means your product price will be relatively lower, right? So your import competing product will be more competitive. Import competing products are those products that are similar to imported goods. Okay, that means you produce car that is similar to imported car. Then this car that is produced in your country will be an import competing product. So if your inflation rate is lower, your import competing product will be cheaper. So it will be more competitive. Then demand for import definitely will fall. If the product is similar, locally I can get it cheaper, why import? So demand for import lower, import spend will fall, causes supply of AUD to fall, hence AUD appreciate. Okay, number 6, BOP movement, balance of payment movement. Okay, so this one I've actually covered in chapter 4. Okay, when we see how exchange rate movement affect the relationship between CAD and KAS. The first link between CAD and KAS was this one. Okay, import, income, outflow, capital outflow, all these are outflow transactions, will result in more supply and hence depreciate. Export, income inflow, capital inflow, these are inflow transaction, will result in more demand for AUD, AUD appreciate. Okay, so if your country, this is like conclusion for everything, if your inflation rate is lower or your or reduces and your productivity level is higher, if that's the case, of course then your export will rise, import will fall. Export rise, demand for AUD rise. Import fall, supply for AUD fall. Both takes place, AUD appreciate. Even one of it takes place, also AUD would appreciate. Okay, then we say if interest rate differential is increasing, that means your country interest rate is higher. Australia interest rate is higher than other country. Okay, your interest rate can fall. Like Australia, it has been falling, but as long as it is higher than other country and the gap is wider, fall 0.75, other country 0.25 already. Okay, even it can go up to 0. Yeah, so if that's the case, the gap is widened here, 0.75 to 0. The gap is widened. So if the gap is widened, the differential is wide, then the difference is wider, then it will attract more investors, more capital inflow, demand for AUD would rise and AUD would appreciate. Okay, that's all for key determinants of exchange rate. Thank you so much.